understood everything? Yeah. Let me jump. Okay, so remember you're learning unit 1. Okay, this is very important. I've provided you with this, and you can see if you compare to what you have, it's slightly different because I'm always upgrading it. And I will share this one. This one is called Learning Unit 1 Annotated 2.0. It means I'm always providing new content to you, new summaries, so that you are clear. I repeat again, guys, you're going to choose whether you're going to pass this module or fail, and it's up to you. It has nothing to do with the lecturer. Right. So remember again, financial management, like I said, financial management is not the sister of accounting. Financial management, it is the mother of accounting. Financial management has 3 children. Financial management covers investment, financing, as well as accounting. So this, if you've been struggling with accounting, by going through this module, you will be doing well for your accounting because this is the mother, right? So obviously, it's time now to relax a little bit. Any questions after all that I've said? Okay, I don't see any questions here. Nothing type. All good for now. Right. So thank guys. You could see the energy that I've spent to make sure that you are on the right page. You understand everything. Guys, let's do this. I don't want to see you back in my class. You are gonna pass this module. And you will understand why. Like I tell you, it's not bragging, right? It's just to tell you that it is clear that this is the most important module that you're going to have. Every aspect of the business cannot function without financial management. Okay, there's a question there. How well do we need to know accounting before starting this module? If you know you've done accounting 1 for the first year, accounting, that's a good thing. That's a good thing. If you've done accounting, that's a good thing. It is going to help you. All right, it's going to help you to understand when we're covering the accounting section. But let me say, you don't need to have done accounting though. So whether you've done it, whether you are struggling with accounting, whether you still need to do it, this is like I said, finance is the mother. Finance has three branches, as you can see on my screen here. Because the first question anybody need to ask is, whatever business, whatever venture you would like to engage yourself into, you have to think about the type of business you want to do, which line of business you should be in. So that is called long-term investment. You could be in retail, you could be in manufacturing, you could be in services. It does not matter the type of business. You need to think about it as a long-term investment that is going to provide for you returns. So when we're looking at the long-term investment, we call that the capital budgeting. Budget means that we're looking toward the future. Capital budgeting, it is the long-term investment. So there needs to be a process of planning and managing that long-term business. And that's what we call the investment side of finance. The type of building, the type of machinery, the type of equipment. And the reason why I'm lecturing, I'm not supposed to lecture, but I'm lecturing this because this is foundational. Finance is what comes straight after. Where will we get the money to invest, to pay for these investments? That's what we call financing. Are we going to bring in owners, new owners? Are we going to borrow money in order to finance? You guys have dreams. You are entrepreneurs. I'm very much sure that you are looking toward the future. You cannot be an entrepreneur. You don't know what capital budgeting is. It doesn't matter how brilliant your ideas are. It doesn't matter how sophisticated your plans are. The money is the most important aspect of everything you're going to be doing. When you go to meet potential investors, they will ask you questions about your capital budgeting. Well, you can't say, what's that? Your capital structure. You can't say, what's that? And you call yourself an entrepreneur. Therefore, this is the most important module that you're going to do. And there is a reason. I can back it up. I can back up what I'm talking about, right? So your capital structure obviously will always be about how you're going to bring in the money to invest into those big dreams or big ventures or big projects that you are planning. And there will be an aspect that deals with the working capital management. What does that mean? The day-to-day running of the business. That's where accounting now comes in. How will you manage the everyday financial activities? Collecting money from your customers. How are you going to pay your suppliers? That's where accounting comes in. Are we clear? So I will provide 2.0 for you. I've put some colors. The reason why I do it is so that you can see clearly. Are we clear on what we're talking about?
Yeah, thanks, sir.
Perfect. So the financial function is therefore concerned with this flow of funds. So when you're looking at financial function, you don't need to be a finance major to be an entrepreneur who is business savvy, an entrepreneur who knows financial matters. So, but we are just saying the financial function is basically it is concerned with this flow of funds, money that is coming in, money that is going out. You need to know. So, in particular, this concerns the acquisition of funds, right? How are we going to acquire the funds? That's the financing part. You are acquiring funds to finance, right? And then the application of that fund, buying assets, that's the investment part. And then the final thing is the administration and the reporting on financial matters. That's what is known as accounting. I've made it big, bold, so that you can all see what it's all about. So next time, don't tell me, don't be uncertain anymore about questions about where does finance comes in, where does accounting comes in, right? So here it is. Please do honors. Actually, I was at school and look, I couldn't cope with the other boring theoretical things. For me, finance is very practical, and that's where I tell you guys, if you want to be an entrepreneur who's worth it, his or her salt, don't take, don't think less, or don't take this module not seriously. As so take it seriously. Take it seriously. If you want to remember that at the end of the day, we are dealing with an education system where you will get the paper, but you're still not competent. So this is it. If you get this, you get your hands, you are hands on onto what you want to become, right? So let's cover the fund. So this is not, I want to be again clear. There is even a question for you to compare the financial manager and an entrepreneur. And there's a reason why they put that question there. Very important. Okay, in any case, the objective of the business. Let me cover the objective of the business. So some of you would say, do I need the textbook to cover this? As you can see, I have provided sections of the textbook that you can even read. All right, but let's delve into it, right? So we are talking about the purpose or the objective of the business. There's two things you need to consider. The actual objective of the business is this one: wealth maximization. Are we saying that profit maximization is not important? No, the objective of a business, and thereby of any financial management. Let me not say the financial manager, because you, as an entrepreneur, you can be the financial manager of your enterprise, of your project, of your startup. So the objective is to maximize the shareholder wealth. Any investor you want to maximize want to have a wealth maximization, and there is a difference between the two. Profit maximization, yes, that's the bottom line. We want to have much profit. But there's a trick there. Profit maximization, the way we calculate how much profit we get, right? I'm gonna give you the picture of an income statement. Income minus cost equal profit. Can I repeat that? Income minus cost equal profit. So it's always going to be about what you get in minus what you spent to get that revenue, right? So when we minus everything, including the interest that we are paying, including the tax, we get our net profit. That net profit divided by the number of shares is what we call EPS, earning per share. So the problem with profit maximization, and especially with using EPS is a good indicator of future return due to its correlation with share price. No. Now you say you are talking blah, blah, blah. No, what I'm saying to you is that earning per share, although it is a good indicator, but it is not a good indicator of wealth maximization because it does not take into account the time value of money. And we will cover this, the time value of money. Future cash inflow needs to be discounted to the present value so that we can know the value of those future cash flow today. So 1 million rands that you will get in 1 year, depending on the discount rate, could be 800,000 rands today. Let me give you a good idea of time value for money. All of you buy bread, and for years the price of bread has always been increasing because there are so many factors that come into play: inflation, interest, all those things. So it means that a bread that costs today 11 rand next year might cost 12 rand because that's what we call time value of money. So I hope you're understanding, because that increase is basically why we are all in business. We want our investment or our capital to grow. Otherwise, nobody would be in business. Without that growth, nobody would be in business. Okay, but you don't need to worry too much. We're going to go deeper into this as we move along, right? So let me reiterate. Wealth maximization is the thing that all companies would like to have as an objective. Companies that goes for profit maximization might not be in for the long term. Wealth maximization, building wealth is long term. And that's why we're using share price, because share price is very important for investors. When investors or shareholders want to invest in a company, don't you see that they look at the market? They're looking at the market to see the fluctuation of the share price. Very important, because the share price takes into account the risk, takes into account the time value for money. All right. Okay. So that's it for the objective. You are a student, you are a tertiary student. I hope you've gone through this and read properly. So you are not a secondary level student. You are a tertiary level student. So I expect all of you. I'm just covering the surface. Go read properly all about this, right? But in a nutshell, that's it. And this is a good example, for example, for a financial architecture of this company that is provided on page 3 of your textbook, Learning Unit 1. Example 1 of GlaxoSmithKline. Read what this company has done. I've provided additional notes that I will share with you, but it is very important for you to understand that 3 things were done in this company because they wanted to increase the profit, but not only the profit, they wanted also to increase the wealth. All right? So one of the things that shows you that they are trying to increase not only the profits, which is the we use the earning per share as an indicator, but if you look clearly when they're looking at the return for shareholders, they are using also the ROI, the return on investment. So this is the formula of the return on investment. Whoa. You don't need to worry right now. Don't memorize it, because in Learning Unit 2, we will cover it more in depth. But this shows you the difference between profit maximization and wealth maximization. The best thing I can tell you is that profit maximization is short term. You are looking at the short term. Wealth maximization is the long term, because you want to be in the business for the long term, not for the short term. So I hope that that's very clear to you, and that makes it worth the read, right? Okay, so now let's talk about the role of the financial manager. A financial manager handles the monetary affairs of a business. That we are clear. I got a question about this, but obviously, even if you have multiple choices, check. Whatever talks about money has to do with the financial manager's role. But even though more than that, but that will be the primary things. He deals with money. So monetary affairs of a business, right? Okay. But the primary focus will be on the acquisition. All right. Remember, he needs to acquire assets, but how are we going to finance the acquisition of those assets? That's why it's the acquisition, the financing, but not only that, the management, investment, financing, accounting. I call them the 3 musketeers to make it simple for you: investment, financing, and accounting. All right. So you need to make sure that they are managed properly and that they are used optimally to maximize the wealth of the shareholders. There is a lot of stakeholders that you can get, but the shareholders, when you see shareholders, that's the people that put in the money. They put the money where the mouth is. All right, let's say it that way. Okay, so we're moving on, right? The primary responsibility of a financial manager will be the financial planning and analysis, the investment decision, and the financing decision, right? There is other responsibilities, but those will be the primary. And here in your textbook, there is a good difference between what forecasting is and what budgeting is. Forecasting is in the short term when we're looking toward the future. Budgeting is in the long term. I hope that that's clear. So forecasting, for example, we use historical data. So majority of companies do it 3 times a year. So after 3 months, they're gonna take the data of 3 months of operation, and they're gonna forecast for the next 6 months until the end of the year. After 6 months, they take 6 months of the data. They're gonna forecast for the next 6 months. After 9 months, they're gonna take 9 months worth of data, and they're gonna forecast for the expected 3 remaining months. I hope that's clear. Do your reading. But the difference with the budgeting is the budgeting looks at 1 year in the future. So if we are in 2024, when we do budgeting, we're going to look at 2025. Very easy. All right. So there is also another very important thing, the for the financial planning and analysis. So in the financial planning and analysis, you're going to be doing forecasting and budgeting, looking toward the future, and the financial coordination and control. Obviously, you now need to, whatever whatever you are doing, planning toward the future, you now need to see if the actual results, how you compare the actual results to what you had forecasted or budgeted. That's where the control element comes in. Because if you forecasted that your sales will go high by 20%, but they're only going high by 10%, you need to take corrective measures. All right, so let me take a pause. Good. So let me see the question here. Stakeholder are people interested in a business, can be affected by the business too. You are right. Easy. And shareholder, they put money into the, exactly, plus own the shares of the, that's why we call them shareholders, because they own shares. They own a portion of the business. Shares is just another way of saying they own a portion of the business. They own a portion of the assets, right? That's good. So Yusuf says, essentially, I am selling phones. Uh, um, a stakeholder would be a person that buys the phone. Exactly, because you have your clientele, you have your customers and clients, patrons of your business, if it is a restaurant, you see. So all those people obviously have some interest, a vested interest. That's the good word, a vested interest in your business. All right, so we are done with financial forecasting and budgeting. Do your due diligence and do your reading, right? Now, investment decisions, very important. Investment decisions, there's only two things that you need to look at. There is the short term. When I write ST, you can see it's short term. There is medium and long term decisions that you need to make for your business. All right. So when you're looking at short term, you will deal with what we call the balance sheet of your business. And the balance sheet of the business, we're going to cover it together. And it's one thing that is simple. If you're not understanding anything, you just need to know that a company has assets, right? Some of those assets are long-term assets, and some of those assets are short-term assets, like current assets. Yusuf sells phones. So if Yusuf is selling phones, phones are current assets because they need to be sold in the short term. And some of the decisions is taking, for example, to sell the phone at a discount of 20% is so that he can do deal with in the short term, making sure in the short term is selling phones, right? So you have your asset. And in accounting, any one of you who has done accounting, that's where you have now an advantage, because you know that in accounting, asset equal your liability plus your equity. You know that by heart, right? But for those of you who have not done accounting, don't worry about that. All of that will become clear as we move forward, right? So, the short term, we're going to employ capital management policies to ensure we meet uh, the working capital requirement. What is the working capital requirement? The current asset must always be more than your current liability. Your current asset must always be more than your current liability. Otherwise, you are not making any profit or any money, or your business in the short term is not doing good. But that does not mean it's the end of the business. For example, you can buy an asset that is very expensive and you are leasing the asset. What you need to pay to your to your creditors every single month is maybe 10,000 rand, but you are only getting a return maybe of 5,000 rand every single month. So your current asset is less than your current liability. Okay? But depending on the business, it doesn't mean that it is a bad thing. Depending on the business, right? Okay. The medium and the long term, you have to look at capital budgeting. Remember capital budgeting? The one that we talked at the beginning? We're looking at investment in the long term. And that's why we need to use, for example, the net present value or discounted cash flow in order to meet the requirement, right? Net present value, remember the time value of money? We need to put them today. So basically, this finance is so exciting because you can think about the future today. You can think about future money, but today. That's what finance gives you the ability and the skills to do. So I hope that's exciting for you. At least for me, it is exciting. All right. Okay. All right. So financing decisions. All right. So how the business decide to fund its activity. Very important. Are we going to take debt? Are we going to borrow money from the bank? Yusuf, with a business that sells phone, in order to start his business, he needs money. How is Yusuf going to get that money? Is he going to borrow money? Or is going to bring in an investor to come and assist him? If he's borrowing money, that's debt financing. If he's bringing in a shareholder, that equity financing. I hope that is crystal clear. Right. Very simple. Do your due diligence, read tertiary level student, make sure that you understand these terms, and even if it's not making clear, like I said, always do a second read on your learning unit. Right? Please do a second read. And if it is not clear, don't worry. As we go, There is learning units. The subsequent learning unit are designed to delve deep into each important section, right? Um, Let me check if there's, so just a pause there. All right, so I'm providing you some notes on the side, some sections that should show you. But we were talking about the stakeholder just now, right? There is many stakeholders, obviously. The shareholder will be the one who's putting the money. But remember, even when we do financial reporting, our report is read by all our stakeholders, our shareholders, our creditors. Who are our creditors? It could be our suppliers. They give us phones, for example, in a business that sells phone, we get our phones from a supplier who can give those phones to us on credit because we might not have the money to pay him cash. But when we talk about giving on credit, it means that I'm taking it now, but I will repay you later. Now, the terms of our agreement will be bound by a time period, right? So we have our creditors. Your employees are a stakeholder. If your employee is sick or they are on strike, they don't want to work, it affects your business. All right. Your government, you need to pay attention to the government. Customers, we talked about it, and the community at large. You know, if you're dealing with mining companies, for example, the community is a very important stakeholder. Why? Let's say you are doing a business that is polluting the atmosphere or the environment. That pollution is going to affect the community. And the community, if you're not managing properly that relationship, the community can voice their concerns and shut down your business. So it's very important to manage this relationship. All right. So relationship management, but also financial markets is also very important because majority of your investors, especially for big companies, you would have, if you are a small company, you could be also a big company, but you have few private investors. But let's say you don't have few private investors to invest into your ideas, into your business. In that case, you will go on the stock market and you could seek investment from the public, right? So it is very important to understand these things. So dividend decisions is also very important for financial matters, financial management. You as an entrepreneur and a finance, the finance person, sorry, the finance savvy that you are, you need to be able to understand that the profit that you get, any profit that you get, it could be decided whether you want to reward, to give some of that profit. I repeat again, you could decide to give some of that profit back to your shareholders. You can distribute some of that profit. And that profit, that part of the profit that is distributed to your shareholders is called dividend. Now, it's not necessary. There's some companies that have not yet paid dividend. I heard that Apple, if I'm not mistaken, it might be Apple or Facebook, went on for years and years and years and years and have never paid dividends. Why? Because as a financial manager, you have the responsibility to see if it's going to be worth it to give back some of the profit, or to use that profit to reinvest that profit into other projects, into other business to grow the company. I hope I'm being clear here. So you need to make a decision. That's why it's called dividend decisions. You need to take a decision. If there is no other project you can invest in, maybe you can return some of that profit to your shareholders so that your shareholders can invest in other projects, right? So that they can invest in other project. But otherwise, you can retain that profit. So when you take the profit, you minus the dividends that you pay out, the rest is called the retained earning or income. All right? And that return earning is what you're going to use to continue to grow the business. Very simple, very clear. Do your due diligence, read. You need to think about risk. You need to manage risk. And with regard to risk, as you can see, some things are very easy. There's three different kind of risk you can have. You're going to have operational risk, strategic risk. Strategic means you are looking at the long-term objectives of the business, and financial risk. Financial risk always will touch on the money. The possibility of losing money on an investment is a financial risk, right? Okay. So you will get your a principle, but the higher the risk you take, normally the higher the return, and the lower the risk. Obviously, every business is subject to uncertainty. You cannot calculate uncertainty, but you can calculate risk. That's why we say business take a calculated risk. As an as an entrepreneur, as a finance savvy entrepreneur, you have to take calculated risk, and those calculated risks could pay you a high return. Okay. So the main purpose, I'm reading, the main purpose of finance from Tuvia is wealth maximization. Why would the company ever give out dividend and not reinvest the money back in the business? That question was answered, Tuvia. So if a company does not see potential project, future projects to reinvest in the short term or in the long term, they might return that money to the investors. Why? Because the investors will be pretty upset that that money was not returned for them to look at other projects to invest in. So basically, that's why the financial manager is tasked with looking at future projects to grow the business, to grow the company. So if there's still projects to grow the business, to grow the company, right, there is no need to return that money. We understand? There is no need to return that money. So there are ethical consideration. As you can see, um, financial management is bound by ethical considerations. They're very important. And financial manager professional, if you are an investor one day, you are an entrepreneur and you're looking for a financial manager, make sure that that financial manager is registered, because financial managers need to comply with ethical code of a professional body. For example, the IPFM, the Institute of Professional Financial Managers, right? So this is to ensure that there is no unethical uh, activities that are happening. For example, you need to make sure that shareholders' rights are protected, right? Not violated. Our shareholder rights are remedied when they are violated, right? Mutual shareholder wealth maximization. You can't have a financial manager who is trying to benefit more some shareholders and not others. Doesn't make sense. It's unethical. So there is ethics and a code of conduct, right? A good example, 1.2, actually speaks fully about that. You can't have a financial manager who has conflict of interest, right? Very important. Confidentiality. Can't have a financial manager or finance people that are diverging confidential information. You see, uh, uh, reporting. There needs to be reporting, right, on unethical behavior, right? Okay. I'm gonna finish with the agency relationship and problem, right? Very important thing for you to understand. Sometimes you might confuse it with a conflict of interest, but the agency problem is this. The agency problem is that the finance or the management of a company is hired by the shareholders to look after the business. So the financial manager is hired by the shareholders in order to look after the financial matters of the business. So in that case, the financial manager is an agent of the shareholders. Now, the problem is there is an information asymmetry because the financial manager will know more about the business than the actual shareholders. If you are an investor, you are sitting in your couch, you have invested money, you are just dreaming about some returns. I'm just putting it in a way where we can all agree, right? So one thing that you want just your company you want that your company be looked well after. But what is really the financial manager doing? Is he really acting in your best interest? This is the question that majority of shareholders ask. Is the financial manager acting in my best interest? And that's what we call the agency problem, right? You want to make sure that the decisions that the financial manager is taking, it is for the good, for the growth, and for the maximization of the value of the money that you invested, right? So there is a problem when the objectives of the business do not align with the personal objectives of the financial manager. Look, you have a business, uh, the objective of the financial manager starts to deviate. That's a problem. And you want to make sure that that's not the case, right? There should not be a conflict. Yes, guys, if you want to run, at the end of the day, remember that there is that 30 minutes. Actually, Damon, I'm on time because that 30 minute there is that 30 minute of introduction. So there's 1 hour for covering. So we are almost at the end. That's the last point. So, but if you have to rush, no worries. You can rush. The recording will be available, and I will put it in a format where it's not going to be burdensome, because I divide the recording so that it's digestible. So there could be a part one and a part two, for example. All right. So financial managers could take more or less risk than they should. All right. If you have a financial manager who has personal ambition, um, of achievement, so he might take more risk than he should. You could have another financial manager who, for example, just doesn't want to lose his job, want to play it safe, don't want to take too much risk, but he might forgo very important business. So that's what it's about. Please make a read, and basically we have come to the end. So, what have we covered? The financial manager is responsible for the financial planning and analysis, investing, and financial decisions of the business. The financial manager's key objective is to maximize shareholder wealth, right? The key difference between profit maximization and shareholder wealth maximization is the timing of the cash flow, time value of money, and risk. Don't forget that. So, the existence of ethical standard and code of conduct are key to ensuring the business is run in a professional and effective manner. The agency problem may pose a threat for the creation of shareholder wealth. All right. So in the learning unit that will come, before I open for maybe a last question for anyone who has, we're going to cover the financial planning and analysis in depth. We're gonna, from learning unit 2, we're gonna look at how to interpret financial results using tools like ratio analysis. Very important. Investing decision making, including work capital requirement, techniques, and all that. Financial decisions as well. Okay, so guys, any questions? The floor is yours. Any question?